Ever wondered how your property's value is determined, or what happens when you decide to use it differently? It is a question many property owners consider, especially when life plans evolve, leading to changes in how a home or land is utilized. When you change how your property is used, say from your primary home to a rental or business, it can absolutely change how your property is assessed for tax purposes. This often results in a different tax bill because assessors classify properties based on their actual use, and this classification directly influences their valuation and applicable tax rates. The primary reason for this impact stems from how local tax authorities categorize and value different types of property. Owner-occupied homes often benefit from specific exemptions, like a homestead exemption, which reduces the taxable value of the property. When a home becomes a rental, it typically loses these exemptions, leading to a higher assessed value. Additionally, assessors might use different valuation methodologies. For instance, an owner-occupied residential property is often valued based on comparable sales, but an investment property might be valued using an income approach, considering its potential rental income, which could yield a higher assessment. Furthermore, local zoning and specific tax rate schedules often differentiate between residential, commercial, and investment properties, applying varying percentages to their assessed values. To navigate this process smoothly, start by contacting your local assessor's office or tax authority well in advance of any change in use. They can explain the specific zoning regulations and tax classifications relevant to your area and property. It is also wise to understand any potential loss of tax benefits or exemptions you currently enjoy, such as a homestead or senior exemption. Researching local ordinances will help you determine if your intended new use is permitted and what the tax implications will be before making the change. Sometimes, even partial rental of a primary residence can affect your tax situation. Property assessors look at the highest and best use of a property when determining its value, considering what a willing buyer would pay for it under its current or potential usage. This principle means that a property capable of generating income, like a rental, might be assessed differently than a property used solely as a personal residence. Some jurisdictions even have multiple tiers of residential classification, distinguishing between primary residences, secondary homes, and pure investment properties, each with its own tax implications and assessment methodology. Understanding these nuances upfront empowers you to make informed decisions and avoid unexpected tax burdens. Proactive communication with your local tax authority and careful planning ensure that you are prepared for any changes in your property tax assessment, making transitions much smoother and financially predictable.